If you're retired in the United Kingdom or you're approaching retirement in the near future, this is one of those moments when paying attention could make a genuine difference to your finances. Over the past few days, the political conversation has shifted dramatically, and with a new Prime Minister now in office, discussions about taxation, property, and retirement income have moved straight to the top of the national agenda. For pensioners, this is not simply another political headline. Several separate tax developments are now moving forward at the same time, and together they have the potential to affect the money you keep every month, the value of your home, the tax you pay when selling assets, and even the cost of everyday purchases. Many people assume that once they retire, their financial situation becomes relatively predictable. The pension arrives, household bills are paid, and the tax system remains largely unchanged. Unfortunately, that assumption is not always correct. Tax rules continue to evolve, governments regularly review existing policies, and even proposals that have not yet become law can influence financial decisions long before any legislation is passed. That is exactly why it is worth understanding not only what has already changed, but also what may be coming next, and how those developments could affect your own circumstances. Let's begin with the issue generating the greatest amount of discussion among homeowners. Property taxation has rapidly become one of the most closely watched topics since the arrival of the new government. The proposed high-value council tax surcharge, often referred to as the mansion tax, remains on the agenda and is expected to take effect from April 2028. Under the current proposal, homes in England valued above £2 million would face an additional annual charge ranging from £2,500 to £7,500, collected alongside the existing council tax bill. At first glance, many pensioners dismiss this as something that only affects owners of luxury properties. However, the situation is more complicated than it appears. Recent reporting from organizations representing homeowners and tax professionals suggests that discussions are taking place around the possibility of lowering the qualifying threshold from £2 million to £1.5 million. No final decision has been announced, but the fact that the idea is being openly discussed has attracted considerable attention. Why does that matter? Because thousands of people who purchased ordinary family homes decades ago have seen the value of those properties rise far beyond anything they could have imagined at the time. A house bought for a modest price 30 or 40 years ago may now be worth several times its original value simply because of changes in the housing market. According to the latest available figures, well over 150,000 residential properties in England are now estimated to be worth more than £1.5 million. Many of those owners never considered themselves wealthy. They simply remained in the same home while surrounding property prices increased year after year. Alongside this discussion sits another proposal that could eventually reshape the entire system of property taxation. The current council tax structure still relies on property valuations dating back to 1991. The new government's direction suggests greater interest in a system based on present-day market values rather than historical assessments made more than 3 decades ago. Although no formal legislation has yet been introduced, the possibility of broader reform has become an increasingly important subject for homeowners who want to understand how future tax bills may be calculated. The second major issue concerns capital gains tax. At the moment, the existing rates remain unchanged, with residential property gains taxed at 18% for basic rate taxpayers and 24% for higher rate taxpayers under the current framework. However, taxation experts have noted that wealth taxation appears to be one of the areas receiving growing attention from the new administration. The argument being made is that the United Kingdom relies heavily on taxing employment income, while comparatively less revenue is collected from gains made on assets. That discussion has led many advisors to consider a scenario in which capital gains tax rates could eventually move closer to ordinary income tax rates. If such a change were ever introduced, the financial impact could be substantial for individuals planning to sell second homes, investment properties, or significant share portfolios. For higher rate taxpayers in particular, the amount of tax payable on a future sale could increase considerably compared with today's rules. Importantly, none of these changes have actually taken effect. The current rates remain exactly as they are. Nevertheless, many financial advisors report that clients are already reviewing the timing of planned asset sales because they would rather understand their options before any official announcement is made than react afterwards. For anyone considering selling valuable assets over the next year or two, seeking professional tax advice before making a decision may prove far more valuable than waiting until new rules are formally announced. In the next section, we'll turn to developments that affect virtually every pensioner, including possible changes influencing online shopping costs and a much quieter tax issue that is already affecting hundreds of thousands of retired people across the country without many of them even realizing it. The third issue is one that could eventually affect almost every pensioner in Britain because it concerns something millions of people now do almost every week: shopping online. Alongside wider tax discussions, there has also been growing debate about reforming the way large retailers are taxed. The current business rate system places a significant burden on traditional high street shops, while many of the country's biggest online retailers operate from relatively few large distribution centers. As a result, supporters of reform argue that the existing system no longer reflects the modern economy. One proposal receiving increasing attention is the introduction of a digital sales levy aimed at major online retailers. Nothing has been introduced yet, and no new charge applies today. But if such a measure were eventually adopted, retailers would almost certainly face a decision: absorb the additional cost themselves or pass at least part of it on to customers through higher prices. For pensioners living on fixed incomes, even relatively small increases across everyday purchases can gradually become noticeable over the course of a year. That is why many financial commentators now recommend something very simple. Before placing an order online, compare prices across several retailers instead of assuming the largest platform automatically offers the lowest price. Health products, gardening supplies, books, and household essentials are frequently available elsewhere for less, and spending an extra minute comparing prices could easily save more than many people expect. The final issue is arguably the most important because it is not a future proposal at all. According to the figures discussed in the source material, more pensioners are already becoming liable for income tax each year as frozen personal allowance thresholds interact with rising pension income. Many people never receive a warning that this is happening. They simply discover later that part of their retirement income has become taxable or receive an unexpected assessment from HMRC. The reason is straightforward. As pension income increases while personal tax allowances remain unchanged, even modest additional income from savings, private pensions, or part-time work may push someone's total income above the tax-free threshold. For many retirees, this happens gradually, without any major change in their financial circumstances, which is why the effect often comes as a surprise. Savings interest can also become part of the calculation. With interest rates remaining well above the levels seen only a few years ago, savings that previously generated very little income may now produce enough taxable interest to influence a person's overall tax position. That makes it increasingly important to understand not only how much pension you receive, but also how your total annual income is calculated. For that reason, many advisors encourage pensioners to review their finances regularly, instead of assuming everything will continue exactly as before. Tax-efficient savings products such as ISAs may help reduce taxable interest where appropriate, while married couples and civil partners may wish to check whether they qualify for marriage allowance if one partner has unused personal allowance available. These are practical steps that can make a measurable difference depending on individual circumstances. Looking at the wider picture, all four developments point in the same direction. Property taxation remains under discussion. Capital gains tax continues to attract attention. Online retail taxation is being debated, and more pensioners are finding themselves within the income tax system as financial thresholds remain unchanged. Some of these issues are already affecting households today, while others remain proposals that could still evolve before any final decisions are made. That is why the most sensible approach is neither panic nor complacency. Instead, stay informed, review your own financial position from time to time, and make decisions based on your personal circumstances rather than headlines alone. Understanding how taxes interact with retirement income, property ownership, savings, and future financial plans gives you a far stronger position than reacting after changes have already taken effect. Ultimately, retirement should be about security and peace of mind. The better informed you are about the rules that apply to your own finances, the easier it becomes to protect your income, avoid unnecessary costs, and make confident decisions for the years ahead.